Hi, it's Martin McGrath from Financial Edge Group. We specialise in helping people save on tax and set themselves up for retirement. Today I want to talk to you about a tip that you can action now to help you boost your super and save tax this year. It's called a concessional contribution. And what that is if you've got a lump sum of money, doesn't matter where it's come from, you've saved it, you've inherited it, you've got redraw on your mortgage, all that kind of stuff, you can take that money and you can contribute that into your super fund. Now there's certain limits and amounts of how much you can do. The limit per person per year is $25,000, and that includes what work is put in on your behalf. So check the limits to make sure you're doing an amount that's safe, but let's just use $10,000 because it's a nice round number. You might not have $10,000, but the same principle applies no matter what that number is. When you put that amount into super, you do a special form that means you claim it back on tax. What that means is come to tax time, you'll get a portion of that money back on your tax return. Now, it depends how much you earn. The average Australian falls in a tax bracket which is 34.5%. Some people are at a lower tax bracket, some people are at a higher tax bracket at 47%. But let's use the average, 34.5%. So it means if you put $10,000 into super, make sure you can afford to do so. The closer to your retirement are, the more this makes sense. You'll get $3,450 back on your tax return. Physical cash coming back to you on your tax return on top of your other refund if you normally get it or comes off your tax bill, but that's $3,450 back in tax in this tax year. When it goes into super, you do have to pay some tax. It pays $1,500 in tax. But that difference, which would be $1,950, is money that you have saved, made in this tax strategy. It's a super strategy, tax strategy. That money is now in your super, ideally earning you more and setting yourself better up for retirement, but also it saved you money outside of super in the fact that tax has been saved. Now, that equates to about basically a 20% return on your money. 19.5, but call it a 20% return on your money. So the question is that a good thing to do with your money? The closer you are to retirement, as long as you can afford it, I think it is. There's not many other investments or parking against your mortgage or anything like that where you can get a 20% return on your money that you can action now and get back on your tax return in such a short period of time. Now, importantly, check your limits, make sure you can afford to do it. You might not be able to access it then until retirement, so make sure you can afford to do so. But that's something you can, no matter what the amount is. I use $10,000, but it could be $1,000. It could be $200. Like there's no limit on terms of this. There's a limit at the top, there's not really a limit at the bottom. So that's called a concessional contribution. There's some forms and paperwork you've got to do to make sure you get the best benefit out of it. But that's something that you can action now before the 30th of June to save on your tax this year.